When five major Wall Street firms agree on market direction, retail traders need to pay attention. What we're seeing right now is unprecedented multi-firm consensus on November upside, backed by hard data, institutional flow, and seasonal patterns that have played out 9 times out of 10 historically. Let me walk you through exactly what the smartest money on Wall Street is seeing, and more importantly, how retail traders can position for this. First, the consensus. Goldman Sachs, Bank of America, Nomura, JPMorgan, and Barclays are all aligned. That doesn't happen often. Goldman crossed 6,900 on the SPX for the first time, calling it macro optimism. Nomura says buyers are structurally higher, driven by gamma squeeze mechanics. Barclays points to trade deal optimism screening for residual upside. Bank of America just recorded $3.8 billion in ETF inflows. That's the largest institutional flow since November 2023. When you see this kind of money moving, you don't ignore it, you position. But here's where it gets interesting. Not everyone agrees. UBS is waving the bubble warning flag. They're pointing to 35 times trailing PE ratios. Equity risk premium compressed to 1%. Historically, dangerous territory. But even UBS admits near-term momentum is strong, so we have a tactical versus strategic divergence. Short-term upside into year-end. Long-term caution for 2026. How do you trade that? You play the upside with defined risk structures. Call spreads, not naked longs. Specific strikes. Limited downside. That's how institutions are playing this. And JPMorgan just showed retail exactly how to do it. Published the exact options trade for Amazon earnings. Buy the 235 call. Sell the 245 call. October 31st expiry. Cost $2.13. That's less than 1% of the stock price. The catalyst they're betting on? A WS growth acceleration. JPM's internal models forecast 18.5% AWS growth versus 18% street consensus. Half a point doesn't sound like much, but when you're talking about Amazon Web Services at scale, that's billions in incremental revenue. Plus, there's the OBBBA benefit. Amazon can immediately expense ICAPEX under the new accounting rules. That's an earnings lift right there. JPM's 12-month price target on Amazon is $265. That's 18% upside from current levels. But they're not buying stock. They're buying a 3-day call spread with defined risk. That's the institutional playbook. Maximum upside, capped downside, specific expiry tied to a binary event. Now let's talk about what's actually moving markets right now. Flow. Bank of America's latest equity client flow report shows institutions flipped from net sellers to net buyers. That $3.8 billion in ETF inflows, $0.9 billion went into single stocks. This is massive rotation. Which sectors are catching the flow? Financials are leading. They have the biggest upward earnings revisions for Q3. Staples are also seeing heavy inflows, defensive positioning with growth exposure. That's a smart macro bet. Tech, 2 weeks straight of outflows. But here's the nuance. Single stock selling but ETF buying, that's rotation within the sector. Retail dumping individual names. Institutions buying broad tech exposure. And materials just hit a 17-month high in 4-week average inflows. That's a cyclical bet. When you see materials inflows spike, institutions are positioning for growth acceleration. This is what a flow reversal looks like. And here's the rule. Flow leads price. Always. If you're watching price action and ignoring flow data, you're trading blind. Institutions see flow first, they trade on it. Then price catches up days or weeks later. Retail sees the price move after it's already happened. This is the information asymmetry that separates professional traders from retail. Now let's layer in the third data point. Seasonality. November has a 9 out of 10 win rate. That's not hopium. That's historical data. Bank of America's seasonality research shows the Russell 2000 up 2.64% on average in November. Healthcare, plus 2.52% with an 83% win rate. Consumer discretionary, up 3.14%. Small cap industrials absolutely crush it in November. 6.1% average gain, 79% of the time, and bonds. 30-year Treasury yields fall 10.16 basis points 77% of the time in November. That's a duration play. If you're positioned in long bonds, November has been historically favorable, but there's always an outlier. Energy, down 3% on average. 63% of the time it drops in November. So what's the play? Long healthcare, long consumer discretionary, long small cap industrials, short energy. That's the seasonal playbook. And when you combine seasonality with institutional flow and multi-firm consensus, you're stacking probabilities. You're not guessing. You're following the data. Let me show you how all of this connects. We have 5 Wall Street firms saying November rallies. We have the largest institutional equity inflow in nearly 2 years. We have seasonality showing 9 out of 10 November wins. And we have specific trades like the Amazon call spread showing how institutions are positioning with defined risk. This isn't one data point. This is convergence. When fundamental flows, technical setups, and seasonal patterns all align, that's when you have the highest probability trades. And right now, all 3 are pointing in the same direction. November upside with tactical positioning. But let's be honest about the risks. UBS is not wrong about valuations. 35 times PE is expensive by historical standards. 1% equity risk premium means the market is not pricing in much downside. If macro data deteriorates, if earnings disappoint, if geopolitical risks spike, this market can reprice fast. That's why defined risk matters. That's why call spreads beat naked longs. That's why position sizing matters more than ever. You're not betting the farm. You're allocating capital to high probability setups with asymmetric risk reward. You're playing offense with defense built in, and you're following the same playbook institutions use. They don't gamble, they calculate. They size positions based on expected value. They use options to define risk. They layer in multiple confirming signals before committing capital. Here's what retail traders get wrong. They see one bullish headline and go all in. They buy at the money calls with no hedge. They risk 10% to make 10%. That's not a trade, that's a coin flip. Institutions risk 1 to make 3 or 1 to make 5. They stack edge. They wait for convergence. They execute when probabilities are in their favor. And right now, probabilities favor November upside. But you have to trade it correctly. Use the JPMorgan Amazon structure as a template. Buy a near the money call. Sell a further out of the money call. Define your max loss. Define your max gain. Pick an expiry tied to a catalyst. Earnings, FOMC, economic data. Don't just buy random expiries. Tie your thesis to an event and diversify across sectors. Don't just play tech. Layer in healthcare for the seasonality edge. Add financials for the earnings revision momentum. Short energy if you want to capture the seasonal underperformance. Build a portfolio of high conviction ideas, not a single levered bet. The November playbook is clear. Follow institutional flow. Respect seasonal patterns. Use defined risk structures. Don't fight the multi-firm consensus. And don't ignore the UBS warning about valuations. Both can be true. Tactical upside into year-end. Strategic caution for 2026. This is how you trade like institutions. Information first. Positioning second. Risk management always. Wall Street just handed retail the November playbook. The question is whether retail will follow it. Full breakdown with exact ETF tickers, specific strike selections, and sector rotation strategy available now at Gekko Wire. This is where professional investment research gets shared with retail traders. Same signals, same data, zero gatekeeping. Wall Street's edge was information. Not anymore. Follow Gekko Wire.